There's a saying that goes, the bigger they are, the harder they fall. A company that was once valued at a whopping $22 billion is now on the verge of a collapse, with its valuation dropped by 99%. BYJU'S, the education giant with sports legends like Messi as its ambassador, and a company which even sponsored the IPL tournaments, is now facing a shocking downfall. But what went wrong with BYJU'S, the edtech giant that once revolutionized the learning experience of millions of students? Is this the end of India's tech unicorn, or is there still a hope left for a comeback? Let's analyze the shocking downfall of BYJU'S and why this massive bubble burst. BYJU'S was not just another startup. Launched in 2011 by Baiju Ravindran, the company started with a simple vision to transform India's education. At a time when traditional classrooms were the only way students could learn, BYJU'S burst onto the scene with the promise of interactive and engaging online education. In fact, some of you watching this video might have used BYJU'S yourself. With animated lessons, personalized learning, and easy to access courses, BYJU'S quickly became a household name, helping students crack some of India's toughest exams. At its peak, BYJU'S was valued at $22 billion, making it highest valued edtech company in the world. But now, that valuation has dropped to a mere $200 million. To understand its downfall, we first need to understand how it rose to such incredible heights. BYJU'S founder Baiju Ravindran's story is nothing short of inspiring. Baiju Ravindran, an engineer turned teacher, started by conducting exam prep workshops. These workshops got so successful that they soon became a full-blown educational app by 2015. Students and parents across India were drawn to the convenience of learning from home. With India's booming smartphone market, BYJU'S capitalized on the edtech wave. BYJU'S raised hundreds of millions in funding from top investors like Chan Zuckerberg Initiative, Sequoia Capital, and Tencent. By 2021, when the pandemic forced millions of students to study online, BYJU'S was perfectly positioned to take the advantage. They grew exponentially, acquiring smaller edtech companies like White Hat Junior, Akash Educational Services. Despite its massive success, BYJU'S was burning through cash at an alarming rate. To maintain its growth trajectory, it relied heavily on aggressive marketing and customer acquisition strategies. The company spent an estimated 1,500 crores on advertisements alone between 2019 and 2020. But behind the glitzy marketing was a business model that started to show its cracks. Many parents reported being pressurized by BYJU'S sales teams into signing up for expensive courses. The National Commission for Protection of the Child Rights (NCPCR) had to intervene, accusing BYJU'S of predatory sales practices. As BYJU'S aggressively expanded, their acquisitions of companies like White Hat Junior and Akash came at a steep cost. BYJU'S took on massive debts to fuel these buyouts. And when you combine debt with a shaky revenue model, things can go down really fast. By mid-2022, BYJU'S has accumulated a staggering $1.2 billion in debt. And while the pandemic initially boosted online learning, the time when schools reopened, demand for BYJU'S services plummeted. But the real turning point came when BYJU'S failed to file its financial statements for fiscal year 2021 on time, sending alarm bells ringing among investors. As BYJU'S struggled to maintain its growth, the cracks in its business model turned into complete fractures. In 2023, BYJU'S valuation collapsed by 99%, dropping from $22 billion to $200 million. The reasons for this are many. First, investors lost their faith as the company's financial transparency issues piled up. BYJU'S had consistently delayed filing financial reports, raising suspicions about the company's cash flow problems. Second, several employees from the BYJU'S reported a toxic work culture, citing intense pressure to hit sales targets. The aggressive sales tactics that once fueled the company's growth now became a public relations nightmare. And third, the edtech boom that had skyrocketed BYJU'S growth during the pandemic didn't last long enough. Students returned to the physical classrooms and the demand for online learning dropped drastically. The once flourishing company now found itself with mounting debts, staggering losses, and a tarnished reputation. BYJU'S isn't just an isolated case, it's a cautionary tale for all startups. It highlights the dangers of hypergrowth fueled by unsustainable practices. Many experts have pointed out that BYJU'S followed the classic strategy, growth at all costs, where customer acquisition and market domination overshadow long-term sustainability. By focusing too much on short-term gains, companies like BYJU'S risk losing sight of the very foundation that makes business successful, the transparency and customer trust. The downfall of BYJU'S reminds us of the dangers of the bubbles in startup world. So what can we learn from the downfall of BYJU'S? First, although growth is important, it has to be sustainable. Companies that rely too heavily on debt or or aggressive expansion find themselves in deep waters when market conditions change. Transparency is critical. Delaying financial reports or holding key business metrics only erodes trust with investors and customers. And finally, the importance of ethics in business. Aggressive sales tactics might win short term gains, but they can destroy long term reputation, like in BYJU'S case. BYJU'S still has a chance to turn things around, but it'll require a massive overhaul in the way they operate. And for us, let's take this case study as a lesson in how even the most promising companies can fall from the sky to the ground if they don't keep the fundamentals in check. So, what do you think? Can BYJU'S make a comeback, or is this the end of India's biggest edtech giant? Let me know your thoughts in the comments below. And don't forget to hit that like button if you like this video. Subscribe for more in-depth breakdowns like this one. See you in the next video.